Welcome to a special episode of the Signature Sip podcast. And I have a guest expert here, Toby. She is a tax expert and tax advisor. And this might be the best 60 minutes return on investment that you're going to have all year. Because in this episode, we're going to talk about how to save a ton of money on taxes. And we're going to show you a tax stacking strategy for tax savings. So check it out and watch the whole thing. I promise you won't regret it. So Toby, say hello to everybody.
Hi, everyone. I'm so excited to be here this morning with John. And like you said, this may be the best investment of your time. And I hope you stay tuned to watch it to the end.
Absolutely. We trade our hours for, money, and then that money gets taxed pretty heavily. And today we're going to talk about how to really reduce that. So let's just jump right in, Toby, but we're going to give them a ton of tax strategies. I just want you to give a quick background. How did you get into becoming a tax expert and a tax consultant?
That's a great question. So I used to be like every tax preparer out there, just being reactive like everyone. And then at the end, they file your taxes. They tell you goodbye, go take care of Uncle Sam. And if you don't take care of Uncle Sam, he's going to haunt you. But then I got to a point in my career and I felt like, there has to be a way where we can pre-plan what we want to pay, right? And actually just make provisions for our future, because if we're not making the provision, who's going to make it for us? And I started searching, and of course I made a mistake during my search. I met the wrong person. I believed them, and I almost gave up on the journey. But thankfully I was able to stay strong, and I started finding the answer, just like, I don't know, any inquisitive person out there, right? I started looking for the answer, and that's when I wound up with Robert Kiyosaki's CPA, Tom Wainwright. And I got to be trained by him originally in strategy, and in that community, you could never do a strategy for any client without first doing it for yourself. My husband is into real estate. So I'm like, there is no better way to save or to help anyone than to first save yourself. Because if you don't save yourself, how are you going to be able to save someone else? And that was a strategy they believed in at the time when I was a part of that program. So I ended up having to build a strategy for my family. And then I'm like, I love this space. I love the real estate space. And every CPA out there tend to try to niche. They always say out there, pick a niche. So for me, my family was already doing real estate. It's easier to talk the walk or walk the talk.
Walk the talk.
Walk the talk, yeah. So I decided, you know what, I love this real estate, and it's the father of all strategies if you do it right. So why don't I just stay here? And that's how I ended up niching down to real estate.
I love it. And this is the epitome of working smarter, not harder, right? We're already putting in all the hours. We're putting in all the effort. Now, by just having a little bit of tax strategy and being smart, preparing and not putting our heads in the sand, because I feel like a lot of people do that with taxes. They're like, oh, taxes are complicated. Mm-hmm. And that's why you have people like Toby, guys. So she can help you and do a consultation with you to see what's, the best for you. So today we're going to break everything down and we're going to share some really awesome tax strategies. And then my advice to everybody is for them to do a consultation with you, right? Because everybody's situation is different. Sometimes you're older and you can take more deductions. Sometimes you're at the point where you have to take mandatory distributions, right? Sometimes you have more kids, sometimes you have less kids. And just by tweaking a couple things, you can really save a lot of money. So today we're going to do an example breakdown, right? We're going to do a case study of somebody that is a business owner, whether they're a realtor or they're a real estate investor or they're, a pizza shop owner, right? And somebody that is interested in eventually investing in real estate or currently doing so. So that way we can share those big loophole strategies that we're going to talk about later. But the case study is, and just as an example, everybody, a $250,000 gross income. They have $50,000 in business expenses, right? And we can use some examples of what the chart of accounts would look like. And what are some some things that business owners can do? What's the first thing that you would recommend that's going to make the biggest impact for people for them to reduce their tax liability and have more deductions?
So the first thing that I tell all business owner is the foundation. The foundation of your ability to deduct or to do tax planning is your entity structure. If the structure is not right, then there is nothing you can do about it. It's like when the Bible says the foundation is wrong, then there's nothing you can do. The entity structure is the beginning of your tax planning. And most times I've run into businesses who end up making millions of dollars and they still remain a Schedule C, right? And what comes with a Schedule C is the additional 15.3% of self-employment tax, which is between the FICA and the Medicare. But once a business gets to a level where you know that income, cash flow is sustainable, net income is predictable, right? I think that those kind of businesses have to start sitting with a tax advisor or a tax strategist to see if it's time for them to become an S corporation. Because you don't want to do it too early because of the compliance cost, the cost of additional filing, payroll cost. But if you assess your situations the right way and you work with the right person who is able to talk to you, think with you, and sit on the same side of the table with you like we do, then they'll be able to identify that it's probably time for you to switch to become an S corporation. And it also would depend on your kind of business.
Right.
So
and
just
over
to put it out there.
100,000, right? Like it's, we're not talking like huge
Exactly.
numbers. If you're already making even less sometimes, right? It could still be
50,
worth it.
60.
Yeah, for you to save. If you're only making $50,000, then, you don't have to really worry about it. If you have a goal, last year you made 50 or 60, and then next year you have a goal of doing 6 figures, I think you should consider it already.
You should consider it already.
Right? It's already going to be worth your time and energy, and then it'll be set up for when you have the big years.
That's correct.
Okay, awesome. So what's the second thing? So first is your entity structure, your foundation, so that way we can take the deductions and structure the income in a way that is going to be beneficial to us. Now, I have my own employer, right? I'm set up like an S corporation or an LLC, tax as an S corp. What's a big thing that I can do to save money on taxes?
Retirement.
A retirement account.
So, and the reason I bring that up is because many times business owners, solo practitioners, professionals, or even if they have employees, they end up hustling after the next dollar.
Yeah.
Hustling after how they're going to make the next money. And they get so excited for every income that comes in that they forget that they will never have that energy forever. Right? Sometimes I tell my business owners, I'm like, what if something happens to you? You get in an accident and now you can't walk, or you can't do whatever you do to make you the money that you make. Do you all of a sudden become the government property? Retirement is another major thing that I feel like all business owners, most of them miss. 80% of business owners miss it. But I think that's another huge benefit just from starting from having your solo 401k, where for 2026 as an employee, because you're now both the employer and the employee as an S corporation owner, and it's mandated that once you have an S corp that you run payroll. I've run into business owners who have S corporation and they don't do payroll. That's a huge red flag.
The IRS is going to recapture that.
That's correct. They're going to recategorize it and say it's payroll, and now you're owing penalties and interest, and also...
And they'll charge you on all of it, all of your income, instead of just like 30 or 40% of it.
They will. So why not just do it when you can and when you have the control to do it? So, but once you start running that payroll, now you get $24,500 in solo 401k contribution that you can do for 2026. You also get the employer match opportunity. You're the employer, remember? So the $24,500 is coming out of your payroll, of course, but then the employer, your employer, which is you, matches it. You get a deduction for whatever the match is, 25% again. So right there, you're almost at $50,000.
Yeah, if you pay yourself $100,000 salary, like in this scenario, you're grossing $250. You have business expenses of $50. So the company's making like 200. You'd pay yourself a salary of around 100, maybe a little
around
less.
100, yeah.
So 100,000, 25% match would be 25,000.
25,000.
So as an employee, I'm putting in 24.5.
Mm-hmm.
My company's putting in 25, and it's a deduction.
Right.
So we're saving
that's 49,000.
a ton of money on taxes. It's 49,500 in deductions.
Right, and you can choose to do the tax deferral, right, where you get the deduction for whatever you also put in.
Right.
Right. So your income is like less of your contribution, and you just play with it. When you make the less money in any year, you can always like convert it.
Right.
Again,
to
it's
a Roth
just
if you
to a
need to.
Roth if you need to. So,
but you get 100% tax deduction on your contribution from both the employee and the individual. And then you can also still have a traditional IRA. So talk about that.
Which is the $7,500 that you're able to put into your IRA if you're less than 50 years. So stack that up to whatever we just add now, which is about 57,000.
So we're already at 57, guys, in
from
deductions.
100,000.
All right, so let's keep going. What kind of other things that we can do? You were talking about
the HSA.
Absolutely.
The HSA is another tax deferred benefit. And right now you can also put $8,000 into that for 2026. Stack it up with whatever you already saved.
You're at $65,000. $65,000. And guys, if you don't know what an HSA is, it's a health savings account.
Health savings account.
Right? So you could use that for your medical, bills, and it's tax deductible. You get a contribution where you get to deduct it, and then you could use it for medical stuff later.
And you don't have to use it all in 1 year.
No.
You can keep, and then you can invest it and make sure it keeps growing. You can self-direct it.
Right.
If you like. If you know what investments. And you can make it grow tax-free and then just use it for your health, because no one is promised good health tomorrow.
Right.
We might be healthy today, but you don't know what tomorrow is going to say. So why not do it when you can and make your business pay for it?
And that's for your whole family.
For your family, that's right.
That's a family plan. Okay, what else? We have SALT, right?
We have the SALT, the pass-through entity tax. It's a big one for states like Jersey, New York, California, where we have all these high taxes. And it just became $40,000 from the One Big Beautiful Bill Act. But let's just say conservatively, $20,000, right? What that is saying is if you apply, it's a year-by-year election that you have to make with the state, by the way. You make an election that you want to do the pass-through entity tax. And why do we say pass-through entity tax? An S corporation is a pass-through entity. What that means is S corp doesn't pay taxes in itself. It passes the obligation to the owner, which is you, the business owner. So does a partnership. Partnership is also called a pass-through entity. But I know we're focusing on S corp right now. So you have to make an election with the state and say, hey, state, I would like to elect to do the pass-through entity tax. And the states, once they approve that election, now your business can pay in advance for your state obligation, and you get a deduction from your business for that portion. So let's say 20,000 conservatively.
But up to 40.
Is up to 40,000.
Right, depends on who's watching. You guys have up to 40,000, which used to be before the Big Beautiful Bill.
It used to be $10,000.
Only $10,000, so it went up $30,000 in additional deduction. So you definitely want to take advantage of this.
Oh yeah, and that's between your property taxes as well as your payroll tax, your state taxes on your payroll, plus sales tax and
basically any state and local taxes.
Any state and local taxes. That's why it's called SALT, state and local taxes. And it's a maximum of 40,000. If you make too much, then it becomes 10. But right now, even if we're looking at this 100,000 scenario, let's say conservatively another $20,000.
That's 85,000 so far.
85,000 so far. So I hope you guys are adding up the numbers.
$85,000 in write-offs between the solo K, employee-employer contribution, the SALT
HSA.
deduction, the HSA, right? And then we have a couple other ones to talk about. So what's next?
I would say there are other deductions for business owners, especially people who are realtors, investors, mileage expenses.
Yes.
That's a huge one that many business owners miss and they leave on the table. And again, it's not because they're doing it intentionally, but because everyone is moving fast. Like you're moving tomorrow, they say, meet me here, you're already on your way. But this year, as at 25, it was 70 cents a mile. So 26, 72.5 cents a mile. So you're looking at 10,000 mileage. Even in 25, it was $7,000. So imagine you leaving $7,000 or on the table for Uncle Sam, who is not going to capture it for you.
That's $2,000 in tax savings about.
Right off the back.
Right.
Because there's the deduction, then there's the tax savings implication. You also have home office deduction, which conservatively you could use the simplified method that allows you to take a max of 300 square feet multiplied by $5 a square foot. There are two methods, but even if we're being very conservative, make sure you have a home office, okay? Make sure you actually are not making up the office. But let's even say it's just 300 square footage, right? That's $1,500. 300 times 5, that's additional $1,500. Add your mileage that we just talked about. Add your phone bills, your utility bills, your equipment.
Right.
We all use the computers.
Right.
Right. You need a computer to do your MLS listing or do whatever you're doing.
Your cell phone bill.
Cell phone bills, your utility internet bills. Again, if you have a separate business phone, then you can do it at 100%. But if you have one phone that you use for both business and personal, all you have to do is allocate the percentage of usage.
Right. Like 80-20 or 75-25.
But make sure that you're allocating. Don't take everything.
Right.
Because
don't take
now
100%.
that becomes a red flag.
Right.
Just make sure you're appropriating it to whatever you're doing. Another opportunity is the accountable plan, right? As an S corporation, because in our scenario, this person is an S corp, right? Who is making this 100,000, 250,000, and then W2 of 100 and making 100,000. There's what they call the accountable plan that allows you to reimburse yourself for expenses that you have for the business.
Right.
You just have to make sure, like Tom used to say, you have to change your facts in order to change your tax. That fact is your documentation, which is the substantiation you have to do. Because the goal is treat your business as if you are a big business out there.
Right.
Such that even if you were to get in an audit situation, right, you have the documentations to back up your stance.
Right.
So
let's do the education.
Education.
And then we'll do that one.
Okay. So most times I find many business owners not invest in themselves.
Yeah.
The IRS is going to partner with you to have some of these expenses, right? So why would anybody not want to improve on themselves? I don't get it personally, because whatever you pay for continuing education, as long as it's legitimate, you get to deduct it at 100%.
Right, a seminar, an educational course, an AI course, a real estate course, a mentor, any sort of consulting.
That's right.
All these expenses are 100% tax deductible.
100% tax deductible. 100%, not partially.
I mean, so if we look at, obviously everybody has business expenses, right? Mm-hmm. So if they have, all these things that you're talking about, the mileage, a lot of people probably don't, do that. And you mentioned an app,
right? Because sometimes we're not able to know how much mileage you drive in a year. And once you're filing the tax, the IRS specifically asks you, is there evidence for the mileage? You say yes. Then the IRS says, is it in written format? You have to say yes. So the way to get it is by using, there's an app called Mile IQ, MILE IQ. You can download it. The amount that they charge you is the benefit outweigh the cost, right? And what it does is you turn it on. Every of your drive, it tracks it.
Okay.
Every time you have a minute to yourself, maybe you're just not doing anything or you're watching TV, you can pull up the app and categorize between business expense. This was a personal drive, business, personal. At the end of the year, it's going to add up all of your business drive. Nice. And now you have that mileage to provide to your tax preparer or your CPA, who is going to include it.
I mean, look, let's quantify this. You're driving back and forth from a listing appointment to go see a property. It's 20 miles there, 20 miles back. Guys, that's 40 miles, right? You get 72.5 cents per mile, right? So you're looking at like $30, right? Mm-hmm. Right there.
It adds up fast.
Sorry, $300. It
adds up so fast.
No, it's $30 right there just for that one trip that you're going to be able to write off, right? You do that, even 200 days out of the year, that's going to add up to a lot of money. 10,000 miles is $72.50.
It's $72.50. I mean, it's one of the greatest deductions that any business owner would have. And if you have a home office.
And that's different than, if you depreciate the car, it's one or the other?
It's one or the other.
Okay.
There's either the actual mileage or the standard.
So they should
ask
when you're preparing their taxes, they would ask you like, hey, this is the car I bought. This is my value. You would do the numbers for them and say, all right, let's take the depreciation or let's do the miles depending on how much.
Right. But the issue with that is you have to make your determination the first year you put the vehicle into use.
Oh, okay.
Because
you have to do it every year.
Yes, because if you start with standard, if you start with actual, you could never switch to standard.
Okay.
But if you start with standard, you can switch to actual later.
Got it. See, these are all really important things because it can add up over many years.
Over many years.
Sometimes people go, oh, well, it's not that big of a difference. Well, if it's $1,000 a year difference and you're stacking all these strategies and it's 10 here and it's 15 there and it's 20,000. I mean, with all the things that we're talking about, we're not done yet. You said the home office deduction. They can actually have the accounting plan like you're talking about. It would be more than 1,500.
It will definitely.
The 1,500 is the minimum.
That's the minimum. It's called the simplified method.
Right. The simplified method where they're not going to audit anything. You don't need any documentation for that.
You really don't.
But if you have,
for the square footage of the house.
Yeah. And if you're a licensed realtor and you have a home office that you make calls from, that's justified.
That's justified.
If you're an investor and you don't drive to an office and have a physical office, well, it's justified to have a home office too. Guys, if you have a 2,000 square foot house and you have a 200 square foot office, that's 10% of all of your expenses in the household, right? Your pity payment or your mortgage, your interest, your taxes, your insurance.
Right. If you are an S Corp, right? Yeah. The way to unlock those deductions is by using the accountable plan document.
There you go.
And the way you can do it is you add up, you can literally have a spreadsheet that shows, okay, this is my mortgage. If you rent, even if you don't have a mortgage, your monthly rent still qualifies.
Got it.
So your monthly rent, your insurance, of course, if you don't own the home, you probably are not paying home insurance. Right. But if you own the home, your monthly rent, your property taxes, utilities, insurance. Now, if you did something special for your space, that office space, that is deducted at 100%.
Okay, so if I put in a studio and I have a green screen and mics and, a camera and, I decorate a little bit.
This stuff there. Right?
I painted, I put a logo for my Zooms, right? And I spent $20,000. That's 100% deductible.
That's right.
That's
because
amazing.
It's within the home office itself.
Right.
But anything that is used commonly by the common area, the entire building, then you have to appropriate it based on the square footage, the percentage of occupancy of the home office. And then you reimburse yourself by writing yourself a check, maybe monthly, maybe quarterly.
Right.
And then you just make sure you name it is home office reimbursement, but make sure you have an accountable plan document to substantiate your reimbursement.
And you can help them with that.
Yes, we definitely can.
Awesome. Okay. So let's go to the next one. So far we have 401k, employee, employer. We have your standard business deductions, all these things that we're talking about. We have the SALT. We have the HSA. We have mileage. We have the accountable plan, the home office deductions, education write-offs.
Continuing education. That's right.
Right. And then, obviously all of your other expenses, right? Rents. We talked about the mileage, right? So now let's talk about kids on salary.
Oh, yeah.
If they work for you, it has to be justified.
It has to be justified.
Guys, don't mess around, okay? If your kid's 3 years old, he's not doing anything for you.
So you have to make sure that whatever you pay them is commensurate to the work that they do.
Right.
Don't try to pay a child that is shredding papers $50 an hour.
Right.
Correct?
That doesn't make sense.
Because it has to make sense. You need to also make sure that you have the job description. Yes. Right? Sometimes we even say take pictures of them while they are doing the work.
Stuffing envelopes for investors or realtors.
You have to be able to substantiate your facts. Because what if the IRS is not real? Like you pull up paperwork, pictures showing what they were doing on that day. But again, the beauty of that is what we call tax bracket shifting.
Right.
Right? If you are in a 25-30% tax bracket, and you pay your child $10,000, right? You just shifted tax implication on that $10,000 to your child, who is not going to have to file taxes.
Right, because it's only $10,000.
Because it's only $10,000.
So as a business owner, I get the entire $10,000 write-off.
Deducted, yeah.
So if I was paying 25%, that saves me $2,500.
$2,500.
And then they pay zero.
They pay zero, and they don't have to file taxes.
Right.
And again, we are putting into consideration the state's limits, because if it was for the federal, you could have paid them up to $16,000 and they don't still have to file taxes. But for the state of New Jersey, if you pay them under $10,000 or at least max of 10,
you don't even have to file.
You don't have to file. So that's awesome. Why we're being conservative at $10,000. So imagine if you have 3 children.
Right.
That's $30,000, or even two children. That's $20,000 deductible to the business. That is,
that's significant. And now you can help them, teach them financial education, right? Put the 3 buckets, right? The saving, the investing, the giving, or the spending, whatever it is that you're going to do. And now they can buy some of the stuff that you would have bought, but now it becomes a write-off because, you're paying them to do work. So you're teaching them a skill and you're teaching them to manage money. I wish that when I was 10 years old, that my parents put me on some sort of payroll situation where they would get a write-off. I would learn to manage my money, and then I could budget for sneakers, for a bicycle, for toys, for an investment.
Or even those activities that we have to enroll them for, the soccer, the basketball,
dance.
right?
Yeah,
the
whatever.
dance. Mm-hmm. Now they can
pay
fund that, which you would ordinarily have had to pay for.
Right.
Right. And now they can pay for that through, and you can even open a Roth account for them.
That's right.
Because they are actually working for you.
Right. And they can contribute up to what, 6,000 or 7,000, 7,500?
7,500.
Imagine at 10 years old, if your parents set up a Roth IRA, they paid you 10 grand, you threw $7,500 tax-free, gross tax-free, forever compounding. Guys, pull up a compound interest calculator and tell me how much money $7,500 a year from 10 to 18 years old would be, and then what it compounds for when they're 65. It's millions.
It's millions. Imagine having to invest that money.
Right.
Year over year.
Right.
That's the kind of money these children wake up. They get to 18 and they're like, I have a business idea. You just take the money out of them and be like, go for it.
Or that is like their foundation for their retirement. They can self-direct it. They can invest in a business. They can pick stocks, right? They're like, oh, I love Amazon. I love this. I love that. Okay. Well, show them how they can invest in equities. You're teaching them, right, the principles of the wealthy of investing in things. Right. And then
you're also teaching them how to save and how to know that you have to earn every dime, right? You work for it. And you need to see the expression on the faces of those children when they make the money, at least. They are so excited, even if it's a little bit, and then you tell them this is the savings amount, this is the investing amount. It's beautiful. And then for you, the business owner, you get to deduct it.
Right.
I don't know why we all are not doing it already.
Right. And it's funny, I was in Portugal with my daughter and we were at this little fair and she's like, Daddy, buy me a toy. Right. And I was like, no, I'm going to give you 10 euros. We were in Portugal. I gave her 10 coins, one euro each. And I said, you spend it. And when you give them money to spend, they spend it differently.
Oh yeah, tell me about it.
Right? They spent, and she went and she found a thing with toys that were €1 each, so she got 10 of them.
She got 10 of them. If it was your money, she probably would have only bought one thing for the same 10.
Yes, exactly. And she felt like she got a lot more, and it was psychologically, it was really interesting. So I feel like when you give them ownership and autonomy and control over their money, they can learn. Imagine if they invest 1,000 and it turns into 1,500.
Oh yeah.
And now they see the money duplicating without having to work. How beautiful with investing, having their money work for them. That's what we need to be teaching our kids. Yeah. And you get a huge deduction for doing so. So, look, we're adding up all these things. We are already at a minimum of $42,000 in total annual tax savings.
I agree.
That's a minimum because we only use 20,000 for SALT, Toby.
Mm-hmm. We use 20.
Which you have up to 40 grand, right? We have the mileage, we have the home, and this is savings, not deductions. $42,000 more money in your pocket, okay? We can throw a visual on the screen so you guys can see what we're talking about here. So just to end it with a couple other things, with the big, beautiful bill that came out, why don't you talk a little bit about real estate and Airbnbs and if they make some sort of investment into a project, how does that work, Toby? Tell them.
So
how powerful this could be.
One thing that I tell my clients is, find me a wealthy person that doesn't invest in real estate. I mean, go check all of them out. They all have that portfolio of real estate. And one thing I will never forget to say is, in any business, you are not allowed to make losses consistently for more than 3. If you make losses 3 out of 5 years, the IRS could turn around and say what you have is not a business, it's a hobby, right? But real estate is the only business that the IRS don't mind you making losses consistently. So if I have a path where I can always make losses and nobody's going to have to question those losses, I mean, I'm going to go
be a loser for life.
All
and
in.
The IRS doesn't care.
A loser for life. And the IRS don't care. But here's the thing. In order to go into real estate, you need money, right? So the source of your investment into real estate could be your active income.
Right.
And then you diversify your portfolio. So now let's talk about if you went into real estate and you did a short-term rental strategy.
Okay.
I do understand short-term rental is not for everyone. Not everyone has the patience. So you have to make sure it matches your lifestyle and you're willing to do it for the benefits that comes from it. But when you go ahead and you do short-term rental, now you don't have the 750 hours requirements for a real estate professional. You don't have to be a realtor. And
so what is the hours requirement for? 100
hours.
That's it. 2 hours a week, guys.
100 hours, and that out your participation, material participation test, right? Your hours has to be more than anybody else. So your cleaner must not, if your cleaner is doing 100 hours, you better be having 102 hours or 105 hours. But for me, I'm always saying to my clients, I'm like, do extra, do more, because the IRS could turn around and say, okay, this one don't pass, these hours don't pass. You want to have more than enough such that even if they say they take out a few of your computations, you still can reach up to that 100 hours.
I mean, I've done Airbnbs, and just by responding to people on the app, right, and booking the bookings and emailing back and forth, you're going to spend some time.
And having to actually call a plumber, someone to
tour
go take
the property,
tour the property, or go back for inspection after it is cleaned.
Again, renovations, all that.
Those things add up quickly.
Right. And
there is an app that I'm also going to throw out there if that's okay. Again, they don't pay me anything, just full disclosure, but there's an app called Reps Tracker. REPS, then Tracker, TRACKER. You can use that to track your hours. You know how we say Mile IQ, you use it to track your mileage?
Right.
Use Reps Tracker to track your short-term rental hours.
Love it.
And it's for whatever you do. If your spouse also helps you, both of your hours add up to that same 100 hours.
Awesome. If you're filing jointly.
If you're filing jointly, of course.
Right. That's awesome.
Even if you were not filing jointly, I believe both of you can have your account on the reps and then track the hours towards that one single investment. But here's the thing. The moment you do short-term rental, it triggers your losses from being passive to active. And what does that mean?
That's amazing.
Under normal rental, the IRS says your rental property is passive because you don't have to do anything. A tenant stays there. They pay you monthly. There's not really much you're doing. You're just materially participating by approving the lease and all that.
Right.
But once you do short-term rental, you are no longer seen as a passive investor. It becomes active income. And remember, we said you can make losses year over year. Now you can take those losses and slap it against your income from all sources.
Unbelievable.
So let's say, for example, right? We all know cost bonus depreciation has been reverted back to 100%. So with that bonus depreciation, you are now able to cost segregate that Airbnb property. Take a huge deduction for assets that are 5, 7, 15, and up to 20 years. You can accelerate their depreciation and take it in the first year that you become an Airbnb.
Against all of your income.
Against all income from all sources.
Did you guys hear that? If you're not listening to this with the law, and this just changed with the Big Beautiful Bill.
One big beautiful bill, yes.
Okay, so I want everybody to understand that this wasn't the case before, but now if you buy an Airbnb, For 300,000, you put $100,000 of renovations into it and furniture and all these things. You're going to get the $100,000 write-off against your income sources if you qualify, right?
Say that again.
So we buy it for 300. We put 100 grand in work into it.
Okay. Capital improvements.
Some capital improvements. Okay. A lot of furniture.
Okay.
You know, you're buying beds. You're buying couches. You're buying lamps.
Which is
you're
still
buying candles and silverware and plates. That's all deductible right away.
Deductible. That's right.
And then the other 50. Let's say it's 50-50.
Okay.
50 grand gets capitalized. Right. So now we really have a $350,000 basis.
That's right.
And then we can take a percentage of that. And the $50,000 in furniture and all that stuff, 100% right off that year.
That's right.
The other $50,000 gets capitalized, but it's a $350,000 basis. So how much of a write-off do you think I could get year one for the $350,000?
I would say conservatively $100,000.
So like 30%.
Yeah, conservatively, because first you have to make sure.
So I would get 150 total with the 50 and
with
the 100?
With the 50, yeah, because you have.
Wow.
First thing
150, guys.
From that 350, make sure you're not depreciating land, because land is not depreciable. So you deduct the land, then the remainder portion. So we take like 20% off 20% off of the land. The remaining 80%. Now the cost segregation analyst is going to have to help you identify what portion of the remaining is 5 years, 7 years, 15 years, and 20 years. Right. So let's say conservatively another 30% of the remainder of the 80. Right.
So it's like 30% of 290, 280. It's still going to be a 70,000 plus the 50.
I'm telling you.
So it's a 6-figure write-off, guys.
And that doesn't include your other expenses.
Right.
Like your utility bills, your water bills, all of those are still tax deductible. Your property taxes, your mortgage interests, guys. Right. The mortgage interest, the principal is not deductible, but the interest is deductible. So
your property tax bill, your
property
cleaning
taxes,
bill,
your cleaning,
everything.
The only thing is you cannot have a property manager.
Okay, because you're active.
Because you are the property manager.
Right, you're materially
That's
active.
how you're getting your 100 hours or more.
Right. You have to do that to qualify for this.
Yes, you do.
But basically, if you've saved some money up, you put a down payment on a $300,000 house of 20%. Right? That's 60 grand that you put down. And then you put another, renovation of 100,000 into it. You're into it for 160, but you're going to get $100,000 write-off.
That's like getting your money back.
Deductible.
That's like getting your own money back. Right. Right. And then
that's fantastic.
So
guys, if you're not using real estate, now is the time to do it. If you've put this off, right, and said, I'm going to build this income, this rental income in the future, but you've thought about an Airbnb, come out to our classes, right? Come out to the things that we do. Attend our webinars, right? Because this is where you can take advantage of. This is the biggest one that we talked. It's bigger than the 401k.
It is.
And if you stack all these strategies and you get an Airbnb, forget about it. Like you're going to pay no taxes on up to like $200,000 of income, guys. So look, if you've learned something here, reach out to Toby. Okay, this isn't. We have other stuff on here too, right? There's other things that you guys can do that are more advanced. We didn't want to get into, all the rabbit holes and confuse people. Because
we will stay here all day.
Yeah. So reach out to Toby to set these tax strategies up. Knowledge is not power if you don't implement it, right? You can know everything about getting tax deductions and then not take any of them, right? So make sure that you're setting this up and you're doing it properly. You're going to set your kids up. It's got to be proper. Right? It's got to be documented, right? All these things, the accountable plan that you talked about, these are very, very awesome things. And don't just trade your time for money and then give 30% of your money to the IRS. Be smart. These rules, guys, are meant for us to take advantage of them. But in school, right, they'll teach you a bunch of stuff. We have music class, we have Italian, we have, workshop, we have all these other things that we do, right? We have second languages that we take. But we don't take the second language of financial literacy. We don't take the second language of taxes. And this is a whole nother world.
It is.
Right? And you don't need to learn everything yourself, right? You can rely on somebody like Toby that's going to do a consultation with you. Yeah, of course.
The money you pay Toby is also tax deductible. How about that?
There you go. That's true.
So the question you ask yourself is, do I want to pay? If you don't pay Toby the money, then you have to pay Uncle Sam the money. So who would you rather pay it to? Would you pay it to me so I can help you save some money and then you can use that money to diversify your portfolio? Maybe buy more stock or acquire another asset?
But it's the best return on investment.
It is, but I'm just saying.
It's the best return on investment, guys. Some of you are investing a few $1,000s a year in stocks that are going up, 10%, 20% a year. That's great. There's nothing wrong with that, but the ROI that you get on tax strategy is in the hundreds of percent, right? There's nothing better. And once you've set it up, guess what? You've set it up. And then every year you get to take advantage of it. So your ROI just keeps going up and up and up. So don't hesitate. Okay. Don't procrastinate. Toby, how do they get in touch with you to do this consultation?
So 2 ways. You can either go on our website, which is www.doballc.com. On there, you would see book a consult.
Yep.
You can easily just click the button to book a 15 minutes or 20 minutes free consultation.
Great.
The alternative way, you can also call our phone number, 973-755-5933. Someone on our team is going to pick up the call, and they could also help you facilitate the
scheduling consultation
of the consultation. Yeah.
Guys, reach out to Toby, put yourself in a good position, and learn what tax strategies you're not taking advantage of that are going to help you get ahead for you and your family, not just for retirement, but now while you're actively making a lot of money or looking to make a lot of money. So thank you for joining us. Toby, thank you so much.
Thank you for having me. And I hope you all just take advantage of this education, because there's so many things out there.
Yeah.
People say a lot of things.
Yeah.
But sieve it, find and make sure you can check the tax code. Like whatever we have said now, you can verify it. Okay. We're not saying anything out of the ordinary, because you're working out for your money.
Absolutely.
Take care of yourself.
Absolutely. So we'll see you on the next one, guys. Subscribe, like, and share. Don't be selfish. Share this podcast with people that need to hear tax strategy, people that have kids, that have a business, they could put them on payroll, people that are not contributing to the retirement accounts, and they're not doing all of these awesome strategies that we talked about today. And we'll see you on the next one. Thanks for tuning in.
Thank you.